On to me as we go, I roll down this unfamiliar road. Hey, I've been practicing this song for 4 weeks. I still need more practice, let's just say. It's kind of like when you first get started in real estate, you know. But speaking of finding a home, let's dive into some of the key performance indicators that every new real estate investor should know and track. If you enjoyed our videos and if you found value in this channel, can you do me a favor and hit that subscribe button? It helps us more than you know and allow us to help more people achieve financial freedom. Thanks and enjoy this episode. I'm sorry for this interruption. I've been asked a lot about passive investment. And let's be real, there is nothing passive about being a landlord unless you have a really good property management company. So if you own an Airbnb or a short-term rental and you want to get back your time, please give our team at Buzz Vacation Rental a call at 281-549-8432 or go to our website at pm.buzzvacationrentals.com. Now back to the Real Estate Baller Show. Running a successful real estate business isn't just about finding the perfect property. It's also about tracking the right metrics to ensure your business is thriving. So today, let's talk about some crucial KPIs that any real estate investor should track. All right, the first KPI is number of leads. This is the number of leads that you receive in a month. And we track this number because it helps us to plan for our business. And there's also seasonality in how many leads you receive. We typically get more leads in the summer than we do in the winter month here in Houston and in Texas area. The next KPI is cost per lead. And this cost per lead measures how much you spend to generate one lead. Okay, it's crucial to understand for the efficiency of your marketing efforts, right? And obviously, lowering your cost per lead means you get more leads for less money. And if you are advertising on multiple channels, you should know the cost per lead for each of those channels. It can help you to decide where to spend more or less money. And you know, something I don't get is when there's guys out or gals out there who spend a lot of money to get leads, but don't answer the phone. Might as well, you know, set a stack of 100 bills on fire. The next KPI is cost per acquisition or cost per contract. This KPIs tell you how much you spend to get a contract, a new contract, and it's the buy contract. In our business, we actually track the cost per contract before operational expenses very closely. And if you want to track that and then also track the cost per contract, you know, after marketing and operational expenses, it can be easily done every month, every quarter, every year. The next KPI is appointment to lead ratio. This is the number of leads that result in actual appointment. And we count attended appointment, not set appointments. And it's an important metric to evaluate for your business. In an effective operation, this number range between 50 to 60%. The next KPI is lead conversion rate or closing ratio, and this KPI shows the percentage of leads that result in a contract. A higher conversion rate means better closing skill, that you have good buyer in place, or it could also mean you pay too much. But I hope that it means better skill. For us, we aim to have this number at 10% or higher. The next KPI is time to close. So this KPI tracks the average time it takes to close a deal from initial contact. So from the time that you get the lead to the time we close on the buy. The shorter time indicates that you may have a better process you may be more effective in your sale, your closing techniques and skill. So, and if you take longer, maybe you just like to move on a slower pace. The next KPI that we track is bust ratio. This is the percentage of contracts that fall through compared to the total number of contracts. And no matter how good you are, some of your contract will bust, whether it's due to title issues, due to, seller change their mind, due to things that you did not see when you first came to the property, but later learned and you need to get out of it. This number for us, we try to keep it below 20%. The next KPI we track is days on market. This measured by the time we go live on the property until the day we get it sold, closed, funded. If you wholesale, then obviously your days on market would be 0. So the shorter the days on market, the more effective you are at selling. Or could also mean the market is super hot, right? If you outperform in your market, meaning you're very effective, or you may be missing out on your sale price, like you may be selling your property too low. The next KPI that we track is gross profit per deal. This is how much money you make on a house. And we actually keep it real simple. Your sale price, whatever you get back from the sale, minus all your expenses, and that include your purchase price, your buy closing costs, your holding costs, your rehab costs, your real estate commissions, and then the second closing costs from the sale. So it's the net of that, okay? So sale price minus your all-in number, and that would be your gross profit per deal. Obviously, we also want this number to be bigger, right? The next number we track is average gross profit, and we already got the gross profit per deal. So let's say you do 10 deals for the year, you add them up and you divide by 10, then you get your average gross profit per deal. I like this number to be higher, right? That means you're profitable. And if the number too low, you may be working a little too hard. It's just good to evaluate your business. If your average gross profit per deal is lower, again, then that means you just have to do more deals to get to the profit that you want. The last KPI that we track is return on marketing investment. This number evaluates the effectiveness of your marketing effort. How you calculate this is by dividing the revenue generated from marketing by the marketing cost. If this number is greater than 1, that means you're yielding a positive return from your marketing dollars. So in summary, let's say I want to make $600,000 next year and my average profit per deal is 30. Then if you take 600,000 divide by 30, that means you gotta sell 20 houses. So all these KPI help me to track my business to know if my business is improving or my business is declining. So it's always important to track these KPIs. The other way to look at it also would be, let's say it takes you 60 days to sell a house and you need to sell, like the first house you sell, the profit from that house pay for your expenses, your marketing, your operating costs. The second house you sell is profit in your pocket. So if you want to sell 2 houses a month and it takes you 60 days to sell a house, you gotta make sure that you have property in your pipeline that you are buying so that when you sell these 2 houses you got on the market, you have things coming in your pipeline. And that is all for KPIs. Thanks for watching the REBallers. I hope you found these KPIs helpful for your real estate investing business. Remember, tracking the right metrics can make all the difference in your success. If you enjoyed this episode, don't forget to like and share it with a friend. And if you got any questions or want to share your experience, we want to hear from you, so drop a comment below. See you in the next episode.